Hey there, strivers. You've probably been hearing a lot of buzz about the possible market collapse and even America going bankrupt. Is it time to pack our bags and head for the hills? Or is it just another wave of media hysteria? Let's set the record straight, drill down into this complex mess and try to make sense of it all. But remember, if you want to get down to the bottom of things, you have to stick around till the end of this video. So buckle up and let's dive right in. Our story today starts with the heart of America's financial system, Wall Street. I know, you're probably expecting something different. Sorry, but don't worry, we've got something even more exciting, the US economy. Okay, maybe not that exciting, but it's important, so stick with me here. In the daily news cycle, you will often see headlines screaming about the potential recession, the dollar's collapse, or even the bursting of the infamous everything bubble. It's almost like the apocalypse is just around the corner, but it's essential to remember. Negative headlines do drive more clicks, but they don't necessarily drive the truth. Now, if you have been listening to the financial oracle Warren Buffett, he recently sold his stocks and warned that the incredible period for the US economy might be ending. Should we be worried? Or is it just another case of the rich getting nervous? Let's dive deeper. Inflation, my friends, is the real indicator of our economic health. When it goes up, interest rates stay high, stocks fall, and housing prices follow suit. Currently, the inflation rate is softening, but is it a true reflection of our economy's health? Well, the most watched metric for inflation is the Consumer Price Index, CPI. It's a weighted average of the most frequent consumer purchases, tracked year over year. But the CPI might not be entirely accurate because it includes very volatile items like food and energy. So economists came up with core inflation, which excludes these volatile items. In recent times, inflation declined below expectation, and it's below 5% for the first time since 2021. Sounds like good news, right? But there's a catch. Core inflation, which is arguably a more accurate measure of economic health, sits at 5.5% year over year, and it hasn't changed much since the beginning of the year. Now, let's throw another variable into the mix, the infamous debt ceiling. Simply put, the debt ceiling is the maximum amount of money the US government can borrow. Once the limit is reached, the government has to agree on a new higher debt ceiling or start shutting down, leading to a potential default on its debts. Recently, the Treasury Secretary, Janet Yellen, warned that the US states could run out of cash as soon as June 1st, thanks to lower tax revenues. Now, the debt ceiling has been extended or revised 78 times since 1960, but the current situation is different because the two sides can't seem to agree on a new ceiling. If you're wondering why this is important to you, consider this. Moody's Analytics predicts that in a prolonged standoff, stock prices would fall by almost a fifth, and the economy would contract by more than 4%. That would lead to a loss of more than 7 million jobs. On top of that, Warren Buffett and his partner Charlie Munger have sold 13 billion worth of stock for cash, while also selling 25 billion worth of stock over the last 6 months. So the question on everyone's mind is, are we facing an economic collapse? With high core inflation and a stagnant debt ceiling, things might seem grim, but history has shown us that the US economy is resilient. It has seen worse days and come back stronger. One important thing to remember is that the market has a mind of its own. It's influenced by a multitude of factors, from geopolitical tensions to technological breakthroughs, from consumer sentiment to natural disasters. A single event or a couple of indicators can't conclusively predict a collapse. However, what we can do is to stay informed and prepare for all eventualities. Diversify your investment portfolio, build an emergency fund, and maintain a low debt level. These are the basic principles to personal finance that hold good to any economy. Let's also remember the words of J. Maynard Keynes, one of the most influential economists of the 20th century. He said, "The market can stay irrational longer than you can stay solvent." So while the doomsday headlines might make for a great clickbait, it's essential to stay rational and not give in to panic. In conclusion, my friends, the signs might be worrying, but the economy is a beast of its own. It has surprised us before, and it could surprise us again. So keep an eye out, stay informed, and remember, it's not about timing the market, it's about time in the market. Remember, panic is not a strategy. Stay informed, stay calm, and most importantly, stay tuned. Don't forget to like, share, and subscribe, and hit the bell icon to get notified whenever we post a new video. Until next time, keep thriving.